So welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, we have the Euro USD for our chart. It's quite zoomed in, so allow me to narrow it a little bit. First of all, let's add a couple of toolbars so we can work with. It's through toolbars view and timeframes. Zooming out, you can see that now the pair was in downtrend, bounced practically at the beginning of the month around the 4th of October, and stabilized in a corridor practically late between the 1.0635 and the 1.0460. Let's add also some labels here. Starting with the support lines in green, S1 being at 1.0460. Second support line at 1.0315. And third support line at 1.016. Locking it in. Moving now to the resistance line. Let's have a look what exactly the levels are here. We're talking about the 1.0635. We have mentioned that. So the R1 in red. The R2 at 1.0770. And the R3 at 1.0935. On technical level, we tend to maintain a sideways motion, practically expecting the price action of Euro USD to remain in the corridor. Let's add also label on the trading instrument. So once again, we expect the sideways motion to be maintained in the corridor between the R1 and the S1. For any change, we would require a clear break of the pre-mentioned levels. Say, for example, if the bulls take over, I wouldn't be surprised to see the price action breaking above the R1 1.0635, a level which provides resistance here, but also support here and here. And then start aiming for the 1.0770, which served the pair well as a resistance level right here. On the flip side, should the bears take over, we may see the price action dropping, breaking the S1 1.0460, which provided support here, and start aiming for the 1.0315. We have to note here that the RSI indicator is slightly rising above the reading of 50. It's actually right now at 58, implying that a bullish sentiment may be building up for the pair in the market. So we may see the rise intensifying in the coming 24 hours. Yet once again, for a bullish outlook, I would require a clear break of the R1. Let's move now to cable. Okay, let's add some labels, starting with the trading instrument. Moving on to the resistance lines. Moving now to the second resistance line, being the 1.25. And the first resistance line being the 1.2315. Sorry, that's the 1.2325. My mistake. There you go. Moving now to the support lines, starting with the S1 at 1.2065. Green. Second support line at 1.1925. And the S3 at 1.1760. So the sideways motion is maintained. And at this point, we would like to have also rectangle exactly highlighting the corridor of a potential continuance of the sideways motion. It's clear that the R1 and the S1 tend to act as upper and low boundaries respectively for the sideways motion here. I would be highlighting here also another difference in comparison, say for example with Euro USD, where the RSI indicator does not seem to be deviating from the reading of 50. It's actually running along it. Once again, for a bullish outlook, I would require the pair to rise, break the R1 1.2325, and start aiming for the 1.25 resistance level. On the flip side, should the bears take over, we may see the price action dropping, breaking the S1 1.2065, and start aiming for the S2 1.1925. Let's move now to USD JPY. Zooming a little bit out. That's better. I would like to drill into the daily chart here to have a look at the upward movement. It could be shifted a little bit to the right to to the left, sorry. Back to the forward chart. That's better. So we have a triangle forming here, but before we move on, and discuss direction, allow me to please add some labels here, starting with the 153. That should be in red. Let's correct that. Moving now to, that should be the R3. Moving now to the R2. 151.90. And they are 149.10. Let's verify that level. Sorry, that would be 149.9. Let's have a look at support lines, starting with 148.40. In green. S2 at 147.5. And moving to the S3, 146.20. Now a triangle seems to be forming as the price action seems to have hit the ceiling at the 149.90, while on the other hand, it gets an upward pressure from the upward trend line we have just shown, actually mentioned. Let's add a triangle here. Readjusting the resistance, the support line, the upward trend line actually. Back to the forward chart. And that gives us a clear indication of here. And here. In yellow. So here you have it. We're having a price action of USD JPY being compressed practically between the 149.90 resistance line, which acts as a ceiling right now, and on the other hand, the upward trend line, which was initiated, let's have a look when, back in the 15th of April. Back to the forward chart, readjusting it. Overall, we tend to maintain a bias for a sideways motion to continue, as we have mentioned yesterday. But at this point, I would be highlighting here that should the pair be able to clearly break the 149.90 resistance line, that would verify bullish outlook. It would be able to surpass the widest or the strongest obstacle to its move upwards. On a technical level, we note the bleep here, which was practically at yesterday's American session. And that becomes very interesting if we drill into the minute chart. Let's do that exactly. Widen it. It's as if we have minor interventions. Note this thing here. It was practically in the late European session. We're talking about 100 pips or so. Let's have a look. Yeah, 96, 95 pips. It was a big surprise for USD JPY traders. Out of the norm. Back to the forward chart. However, we have minor bleeps later on as well. So that's an issue which tends to worry USD JPY traders, especially if they are in a long position, as such bleeps could burn out long positions exactly. So some caution is advisable. In any case, should the bulls take over, we may see the price action breaking the R149.90 and start aiming for the 151.90. That's practically a level which is a high level for the pair. Let me show you in the weekly chart. You can see it right here, which was back in October last year. And that was a high level for years, for over 20 years if I'm correct. Back to the forward chart, readjusting. On the other hand, should the pair remain in a sideways manner and stabilize, would expect it to remain below the 149.90 and at some point actually even break the pre-mentioned upward trend line. Now for bearish outlook, however improbable that may be, it's still a possibility and it should be covered. We may see USD JPY dropping, breaking the pre-mentioned upward trend line, exactly in a sign that the upward motion has been interrupted. But for a bearish outlook, I would also require a clear break of the 148.40 support line, a level which provides support once, twice, 3, 4 times here, but also resistance back here. So it was checked on both levels, on both sides. And in that case, I wouldn't be surprised to see the pair start aiming for the 147.50. One small point which is being made by our followers here is that the S1, the S2 and the S3 could go lower. And actually that's pretty valid. Could go like this. On the other hand though, we have to note that there's some resistance here. So that makes the level even more valid. Okay, we're talking about 10 pips lower. Okay. Let's have a look now at AUD-USD. We're adjusting it. Zooming out. Still in the forward chart. Okay, let's add some labels. starting with the 0.6605. Zero 0.6510 is the second resistance line. No question about it, 0.64 is the first resistance line, which is key in our opinion. It's a level which used to be a support line once, twice, 3 times, but also resistance line. And that's why we mentioned this as key. I would be avoiding this peak here. Moving now to the first support line being placed at 0.6285. And I would like to recheck the S2 and the S3. Give me some sec. Okay, there may be a middle level here. Yet I would prefer this level here. Could go even a bit lower, like here. And let's move on for the next. The ultimate support line. Okay, we have marked the S1 and the S2. Daily chart. $61.65. Could be even 70. Yep. Let's readjust the chart. Back to the forward chart. Repositioning the labels of the resistance lines. Moving now to the support lines. 0.6285 remains as the first support line. Given the touches here and here. And then we have widened the support lines lower. Let's have a look also at the S3, 0.6040, 0.6070. Here you go. S3 at 0.6070. So we're talking about a span of around 600 pips here from S3 to R3. It's pretty wide. Any case, for the time being, we tend to maintain a bias for the sideways motion to continue. Yes, we do recognize that there has been an upward motion in the past 2 days, practically since the start of the week, practically since late American session on Friday. And we can verify that with the needle thread and a gate. Yep, it was in the late American session on Friday. However, for bullish outlook, I would require the pair to rise above the R1 0.64 and start aiming for 0.6510. I would be noting here that the RSI indicator has risen above the reading of 50, implying that the bullish sentiment is building up among market participants for the pair, which could allow exactly the bulls to maintain control. Now, some have added that we may add an upward trend line. Yes, we could. It could be something like this. But once again, for a clear-cut bullish outlook to emerge, I would require the pair to break above the 0.64. And we have to note here that the sideways motion would be described better with a rectangle like here. There was a small break here, but that was for a couple of days. But the price action proved unable to continue higher. Let's move now to use the CAD, also in sideways motion. And this is pretty clear. Note how the support and resistance lines are split in 100 pips intervals. It's characteristic that we have still touches though which verify each level. Actually, the R1 could go even a little bit higher. Yep. Yet the R2 remains, as does the other 3. There is no touching there. So for the time being, we maintain a bias for the sideways motion to be maintained in the corridor between the S1 and the R1 possibly. I would be noting though that the RSI indicator has dropped below the reading of 50 during today's European session, and it's currently at 44, which, okay, it's still not convincing, but it may be an indication that bearish tendencies are building up for the pair, which could drive USD CAD to break the S1 1.36 and start aiming for the 1.35. On the flip side, should the bulls take over for bullish outlook, I would require a clear break of the R1 1.37 here, and the pair to start aiming for the 1.3785. Let's have a look at gold's price, which has risen and broken above our first resistance line. Being the 1932, we have to switch that into a green support line now, given that the price action is above it. Zooming a little bit out to get the bigger picture here. Okay, there was an upward movement which was instigated in the early days of October. However, we have to note that it may have started to steepen right here. Let's go hunting for a new ultimate resistance line. We're marking this peak here, and that would be in red the 2058, 2060. Yep. Readjusting. Let's add some labels, starting with the R3. The R2, 2020. The R1, 1985. Yet, before we move on, let's verify that level. Yep. Moving now to the support lines. We're talking about a wide corridor here, as the S1 is being set at 1932. Yep. The S2 at 1900. And the S3 at 1865, if I'm correct. Yes, it is. So we tend to maintain a bullish outlook for XAU-USD, for gold's price, setting as the next level, the next big test for the bulls, the R1 1985. The RSI indicator is running above the reading of 70, exactly highlighting the strong bullish sentiment of the market for the precious metal. Yet also the upward trend line, as well as the fact that the precious metals price was able to surpass the 1932 obstacle, now turned to support, tends to highlight the bullish prospects for gold's price. There may be some mid levels, yes, but in my opinion, the road is open for the 1985. It's a biggie. Mind you, small catch here. Watch out for the RSI indicator, which may also be implying that the precious metals price may have entered already, or has entered already, overbought levels. And that may drive to a correction lower of gold's price. I would be noting here, though, that the price action is still below the upper Bollinger Band, even slightly, which could allow the precious metal to rise a little bit further. So there's still some room left for the bulls here. I wouldn't be surprised to see it even breaching for a brief period the upper Bollinger Band. Also, I would be noting that we have intensifying bullish sentiment as we have upward bullish crossovers of the 20 on the 20 moving average, which is the blue line in the median of the Bollinger Bands. It crossed over bullish the 50 and the 100 in green and orange respectively, but also the 50 moving average has surpassed the 100, while the 100 moving average is as well keeping an upward slope. All of that tends to support the idea of more bullish action for gold's price. On the other hand, should the bears take over, we may see the price of gold breaking the pre-mentioned first upward trend line and the second upward trend line, but I would also require a break below the 1900s, in my opinion, or at least for the price action to reach that level for a bearish outlook to emerge. I know it's pretty much I'm asking, but there is such a bullish sentiment currently for gold's price that I wouldn't be convinced for a bearish one unless we see a number of barriers to the downside being broken. Let's move now to US stock markets, and I would be highlighting here, first of all, Dow Jones. It's the 1 hour chart. Allow me to drill into the daily chart, and we're getting a different picture here. It's in a make or break position right now. It seems about to breach the upward trend line guiding it. Should that be the case, that would lead us to a possible stabilization of the index. Yet the first reaction would be practically a shift of the upward trend line to the right like this. Once again, for the time being though, we tend to maintain our bullish outlook, yet I would be highlighting a word of caution here. We may see some stabilization. Now you have seen the bullish movement in the daily chart of Dow Jones. Let me show you a contrast here. And we have the US 100 also in the daily chart. Note how the sideways motion prevails in NASDAQ. It's a very different picture, and it relates exactly that the share prices, including the two indexes, differ substantially, with NASDAQ being primarily high tech. So practically the market's pricing in the prospects of different sectors differently, and that's understandable. However, here I think the sideways motion is more clear-cut than Dow Jones. And that should be quite obvious. Now, from my side, we hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
Previous video, we talked about various indicators regarding inflation. In this video, we will look at two indicators related to employment. The first one is the unemployment rate, which is probably the most widely known labor market indicator. It measures the number of unemployed people as a percentage of the labor force. It is lagging indicator, which means that it generally rises or falls when economic conditions change. When the economy is in bad shape and jobs are scarce, the unemployment rate can be expected to rise. When the economy grows at a healthy rate and there are lots of job vacancies, it can be expected to fall. The second indicator is the non-farm payrolls figure, NFP for short. This is a key indicator used primarily for the US employment market, although it is also used for other countries as well. It measures the change in the number of people employed during the survey's month, excluding the farming industry. Basically, the indicator measures the US employment market's ability to create jobs, which also has an effect on consumer spending. It is released on the first Friday of every month and is very closely watched by investors as well as the Fed and other US policymakers. If the indicator rises more than market expectation, the US dollar may strengthen and vice versa. Note that the change in this indicator can be very volatile and could create a wider market distortion, as the ripple effects may also be felt in the US stock markets. Thank you for watching.
Okay, thanks for waiting, everyone. Let's go ahead and get started. So, first things first, a risk warning as per usual. Our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. Okay, so I'm Melanie and I will be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019, 2020, and 2021. Okay, so here's our agenda for today. So we're just going to get right into chart patterns, looking at the top 3 reversal chart patterns and the top 3 continuation chart patterns. And then we're going to look at how we can incorporate them into a strategy. If we have time after that, which we probably should have, we'll then do a recap of Fibonacci and market structure, because then that leads us into other types of patterns, such as your harmonic patterns and your Elliott wave patterns as well. So we're just going to add a bit of bonus for this webinar as well. So if you have any questions throughout the webinar, feel free to let me know in the chat. And yeah, let's go ahead and get right into it. Okay, so what exactly are chart patterns? So chart patterns are visual representations of historical movements in financial markets. So in your stocks, currencies, so like your forex, commodities, so on and so forth. And these patterns are used by traders and analysts to make predictions about future price movements. So the patterns are the distinct formations that's formed by the movements of security prices on a chart, and they serve as the foundation of technical analysis. So a pattern is defined by a line that connects common price points, such as closing prices, highs or lows, over a specific time period. So technical analysis and chartists look for patterns in order to forecast the future direction of a security's price. So these patterns can range from the simple to complex, such as double head and shoulders formations. So let's now look at the top 3 reversal chart patterns. So these chart patterns basically indicate that there will be a reversal in trend. And of course, you would know that there are a lot of different ways for you to identify a trend reversal. But these chart patterns are our top 3 ways. Of course, you should use these not on their own, but also in combination with other technical analysis methods. So like your indicators, your moving averages, MACD, so on and so forth, or even your support and resistance levels, Fibonacci. Yeah, so if you manage to get a confluence area, which means there are multiple indicators that tell you that a trend is reversing, that's a bonus, and it's more likely that what you expect would likely to happen. So firstly, we have a double top. So a double top is a chart pattern where the price reaches a high twice, as you can see from the image that I've shown here. So we have one top and two tops, and it fails to break out higher during the second attempt. So you can see that it reverses off of that same swing high resistance. So the pattern comprises of two peaks of nearly the same size and a bottom between them. So the bottom would just be this valley area over here. And then the neckline is where we measure that support level from the bottom of that valley, I mean. So the line running through the tops is the resistance line, which should be nearly horizontal, and the pattern forms an M shape and is considered a bearish reversal chart pattern. So the pullback between the two highs should be moderate. So the pullback is just over here. And the new minor support level is then called the neckline or the support level. And then the pattern is confirmed once the price breaches the low of the pullback between the two highs. So basically, once it breaks out of this neckline area or the swing low support over here. Okay, so I've also included a candlestick formation of what I'm talking about here. So you can see based off of the chart, we have two swing highs that are about the same, or rather it's about horizontal. And then we have the valley that I was talking about earlier, which forms our neckline. And then eventually when it breaks out of that neckline, which means just over here, this area here, then that's our double top formation, or rather double top confirmation. Okay. Next, let's take a look at double bottom. So a double bottom is a chart where the price holds a low 2 times and fails to break lower during the second attempt and instead continues higher. So yes, you can kind of say that this is the opposite of a double top. So the pattern is characterized by a distinct drop in price, followed by a slight reversal or bounce, with a second drop occurring soon after to either the same or similar level as the first before another. Significant reversal so that the chart appears to take on the form of the letter W. So kind of opposite of double top, we have the neckline, instead of being on the bottom, it's on the top. And then instead of having two tops, we have two bottoms. The double bottom confirmation, similarly to double top, happens once price surpasses the neckline. Okay, so the double bottom reflects very strong levels of support, as you can see here. Okay, strong levels of support often indicates a strong change of trend. So that's why you can see once we see price breaking out of here, we can then assume that price has reversed and we're expecting price to continue upwards instead of continue to hit this strong support level here. So double bottoms appear in a downtrend and reverse it to the upside as price breaks through the resistance line. So in this case, our resistance line is the neckline here. So once again, I've included a candlestick example for you to take a look at. Our double bottom has these two, I was gonna say heads, but in this case, I guess they are kind of swing lows in this case. So our swing lows also form a almost horizontal or horizontal level, and that's kind of what you're looking for over here. It's okay if it exceeds by a little bit, as you can see from our example, but it should be approximately horizontal for you to take note of it. So you can take note of the entire length of the wick, and you don't have to just measure it from the body of the candlestick. And then once price breaks out of this neckline or this resistance level, then we can say that there is a double bottom confirmation. Okay, so far pretty straightforward patterns. Next, let's take a look at heads and shoulders. So this is also pretty common. And the head and shoulders is a chart pattern that's described by 3 peaks. The outside two are close in height and the middle is the highest. So it's a bearish reversal chart pattern. And this begins with an uptrend with 2 higher highs. So you can see from the example here, I have the higher highs here would be number 1 and number 3, and the 2 higher lows. So the 2 higher lows here will be 2 and 4, and these form the left shoulder and the head. So the left shoulder is here, the head is here. Point 5 over here makes a lower high, which is lower than points 3 and 1, and this forms the right shoulder. Okay, and the downward confirmation occurs when price breaks out of this point number 6 here. So we have higher lows from 2 and 4, and that's where we can draw our line across. Once price breaks out of here, then we can say that there is a confirmation that there is bearish reversal happening here. Similarly, I've included a candlestick example here. So same thing, we have, if you implement this diagram onto our real life example on our candlestick chart, point 1 would be here, point 3 here, and point 5 here. So if I were to draw or to measure out a horizontal line, well, it doesn't have to be horizontal, just a line that extends out of connecting these two swing lows. Okay, so if I extend it out, once price breaks out of that line, then we have confirmation that price is going to continue lower. Pretty straightforward. Let me know if you guys have any questions, of course, but yeah, pretty straightforward so far. Next, let's take a look at the top 3 continuation chart patterns. So the previous 3 we looked at were for reversal purposes. Now we're going to see how we know if price is going to continue in its direction. So firstly, we have falling wedge. So all these chart patterns I'm going through now are pretty popular and quite easy to spot on your charts. Later on, when I go through some harmonics and Elliott wave patterns, those are a little bit harder to spot. But yeah, we'll go through those shapes and patterns later on. Okay, so next, let's go into falling wedge. So this is the pattern that I've included here. This is the pattern for you to take note of when you are spotting a falling wedge. So the entry, excuse me, we go for a target that's at least the size of the chart pattern for wedges and rectangles. So in the next slide, we have a rectangle as well. So we go for the target that is at least the size of it. So what we mean by that is, if you take a look at the real life example here, okay, it might be a little bit different from this diagram that I have here. But basically what happens is you have this price moving upwards, and then you have price making lower highs. Okay, so it's making lower highs, whereas our bottom line, or rather the swing lows, if you connect the swing lows, it gives you an approximately horizontal level. Similarly to before, doesn't have to be horizontal, just approximately horizontal is fine. So that would be our stop loss. Okay, once we have this level that we have connected all of the swing highs, that is our entry level. And then we're going in for our take profit or target level would just be slightly above that. So because we're expecting price to break out of this shape, this higher resistance level here. So the upper red line, that's our resistance level, and we are expecting price to break out of it. Because there's a lot of downward pressure that's pushing on this area or this shape, so we're expecting price to break out, and that's why our take profit would be a little bit higher up. So that's why I've arranged the levels in this way for you guys to see. Okay, I hope I explained that properly, but let me know if you guys have any questions. Basically, if you draw out the shapes here, it would connect these three swing highs. If we ignore this area here, because we're expecting price to break out and hit our take profit there. So in the meantime, we'll just look at these three swing highs, connect these levels, and then on our bottom, we have our stop loss, and the stop loss is achieved by connecting the swing lows instead. So we connect the swing lows, that's our stop loss, and then we proceed with our entry. So we go in with our buy entry from this level, and then we see it shoot up to our take profit here. Okay. Okay, if we have time after the slides, we'll definitely take a look at some setups, and I'll definitely take a look at gold. But because this webinar is for chart patterns, so we'll take a look at our slides first. If we have time, then I will take a look at gold. Okay. So our next continuation pattern that we want to talk about is bullish rectangle. Similarly for bearish as well, it's about the same, just opposite areas, or rather opposite direction. So in this case, our bullish rectangle, we have three swing highs, so it doesn't have to be three. If you can see in our example with the candlesticks, it's just a consolidated area in which price is testing the upper boundary and the lower boundary, or resistance and support level. So if you connect this area here, it's pretty easy to spot. It's just about the same length of candlesticks and wicks. So our entry would be the upper boundary, and our stop loss would be the lower boundary. And then we're expecting price to break out of this consolidated area, break out of it, and hit our take profit. Okay, so that's for a bullish rectangle. If we're talking about a bearish rectangle, for example, we can expect our diagram to be the opposite. So instead of price moving upwards, we expect price to move downwards. Same thing though, our entry level instead would be our stop loss, and our stop loss instead would be our entry, or rather our sell entry. And then once we're expecting price to break out of the consolidated area downwards towards our take profit, which would be, of course, lower than our entry level. Okay, so obviously for bullish rectangle, we're going in for a buy, and for our bearish rectangle, we'll be going in for a sell entry. Okay. Next, let's take a look at bullish pennants. So for bullish pennants, some people call this flag shape as well. So yeah, it's entirely up to you what you want to call it, but it's all about the same. So for a bullish flag, we have this shape here. Once again, from all of these shapes, we are basically connecting the swing highs with the other swing highs to form a line, and then we see where those lines connect. Oop, sorry about that. So we connect the lines here, and then we connect the bottom lines as well, and then it should give you this flag kind of shape. Okay, so if we're talking about a bullish flag, price will be moving upwards, and then we will expect price. So price is testing within this consolidated triangle area. So we're expecting price to break out. of this area and continue in the upward movement. That's why we call it a continuation chart pattern. So price trend is upwards, price is consolidating in this area, and then if we draw out the connect the areas, connect the tops and the bottoms, then we have this flag shape, and then the next step would be to measure out your take profit. Okay, so your take profit would be, as we mentioned earlier, either the size of the same size of your shape or bigger. So as you can see here, our shape is you can see the size of our shape here. So our take profit would be times 2 of that. So we would measure our take profit over here. Or rather, we would put our take profit over here. Okay, so for a bearish pennant, on the other hand, same thing, just the opposite. Price will be moving downwards. Okay, instead of our buy entry being over here, we will replace it with our stop loss. And then stop loss, we'll replace it with our sell entry. Price will once again consolidate within this area, okay, or within this triangle. Once it's consolidated, we will place our take profit times 2 below that, okay, and then we'll break out of it and then hit our take profit, hopefully. Okay, but that's just how you use this bearish pennant or bearish flag shape. Okay, so that's actually kind of it for the top 3 chart patterns for continuation and reversal. But I wanted to talk a bit about harmonics and Elliott waves as well. Just briefly touch on it if you missed our previous week's webinars. Okay, because when we're talking about chart patterns, even trend lines, support and resistance, all of that are considered chart patterns as well. So yeah, let's just talk a bit about Elliott wave and harmonics. So before I do that, in order to really understand the harmonics and Elliott wave patterns that we're going to be getting into, I'm just going to do a really quick recap on our Fibonacci, because without Fibonacci, the Elliott wave and harmonic patterns really don't quite make sense. Okay, so we have the different Fibonacci levels here, and if you've been with us for our previous Fibonacci series, we go through in depth the Fibonacci retracement, expansion and extension, as well as projection levels. But for now, I'm just going to briefly go through the retracement levels. So for the negative Fibonacci levels, minus 27.2 and minus 61.8, those are our Fibonacci expansion levels. And then the between 0 to 100 levels, those are considered Fibonacci retracement. And then for the 127.2 and 161.8 or above 100%, those are what we call our Fibonacci extensions. Okay, this GIF here, you can see we are following exactly the pattern, or rather the structure of the market, and that's quite important. So here we show you exactly how to draw your Fibonacci. So for retracement, as you can see from the previous slide, the GIF just follows exactly the shape of the chart. Pretty straightforward. My projection is not showing, I'm not sure why, but I'll show you guys that in a second. Next, if we look at expansions, we're looking for a flash kind of shape. You can see now in this GIF, I'm drawing out exactly this flash shape. Flash or lightning bolt shape, whichever you prefer. So our starting point and ending point for expansions lines up nicely with the head of the lightning bolt. And then for expansions, as I mentioned earlier, we are looking at the negatives. So in minus 27 and minus 61.8, if I'm not wrong. So yeah, so we take notes of those levels and we for point 3, it has to retrace at least 50% of your starting and ending points. If we look at our extensions, you can see we've drawn out this Nike tick kind of shape. And that's exactly what we call Fibonacci extensions, the Nike tick formation, because that's what you're looking for. In this case, we have an upright Nike tick, but in the next couple of slides, I'll show you guys examples of inverted Nike ticks and how you can use those as well. For extensions, we are using more than 100% levels, so the 127 and 161.8. Okay, here you can see all the different Fibonacci numbers that we mentioned in our previous slide and how it looks drawn out. So yeah, I think you guys can see for yourselves. Positive Fibonacci retracements are our expansions. Fibonacci retracements are 0 to 100%. Negative Fibonacci levels are our what we call our expansions. So more than 100% extensions, less than 0% or negative would be expansion. Okay, so here's an example. I have my Fibonacci retracement. So remember I mentioned how important it is for us to follow the market structure. So that's exactly what I did here, my starting point here, ending point here, and I'm looking at where price has retraced this level. So this 23.6, 38.2, 50%, these are no longer valid because price has already passed these levels. Okay, instead I'm taking note of the 61.8 because price has reversed or retraced this level and has reversed off of it. Okay. Okay, here is another example of Fibonacci retracement. Okay, in this case, I'm doing it upside down here. So, oh, am I? No, okay, this is not upside down, sorry. So my starting point here, ending point here. Now I'm seeing once again where my price has retraced to, and I can see my price retraced to the 38.2 level. So I highlighted this level because this dotted line at 32544, it is at this this retracement level, but you can see that price also pulls back all the way to this level here, this swing high. So this is what we call an overlap support. So an overlap support is basically when a swing high lines up with a swing low, and it's important because we can see that price, the bulls as well as the bears both respect this area. So that's why it's important, and that's why I've highlighted it here. Okay, so having an overlap support also line up nicely with a Fibonacci level. That's what we call a confluence area. And so we can probably expect price to reverse off of the area as we can see here. So if you have this and then you couple that with your indicators as well as some of the chart patterns that we've mentioned earlier, then you can see there's a higher chance that your analysis will be correct. Okay, so in this example, we have two Fibonacci retracements. So notice how the big Fibonacci retracement trend line price reverses off the 61.8% Fibonacci retracement level. Okay, so my Fibonacci retracement that I was talking about is here. We have the bigger one and the smaller one here. Okay, so both 61.8, but for the bigger one, my 61.8 lines up with the swing high. Okay, and then my smaller Fibonacci retracement, 61.8 as well, lines up with two swing lows. So this once again is an important level because we see that price has respected this level twice. So it's likely to respect this area again in the future. Okay. Okay, next we're going to get into Fibonacci expansions. So an example of expansion and how it plays out, as I mentioned earlier, expansions, we are looking for a flash shape. So this flash symbol also is applicable for Fibonacci projections. So our starting point is here, ending point here for expansions, and we're taking note of the negatives over here. So firstly, my first point, starting point there, ending point there. Number 3, if you can see here, price retraces up to the 61.8% level. So that is our Fibonacci retracement since it's between 0 to 100%. Yeah, so levels, it respects this 61.8, reverses off of it, and it's heading downwards. And in order for us to project where price is heading towards, that's where our negatives come in. We're expecting price to come down to this negative 27.2, where it could bounce off from support. Okay, and you can see this is the aftermath of that, and that's exactly what happened. Price bounced off and reversed off of our negative 27.2. Okay, bounced off really nicely. And a pro tip is that price usually comes back to this ending point over here. Okay, why does it usually come back? Because as I mentioned earlier, when we have if I were to extend this level, you can see price has tested this level before as well. So we already have two swing lows that line up on the same support level. Now that price has broken out of it, we can expect price to pull back to that level. Okay? Next, we're going to get into Fibonacci extensions. So we are moving a little bit fast because I want to get into the chart patterns for the harmonics and Elliott wave patterns, since this webinar focuses on chart patterns. So I want to quickly get through the Fibonacci recap so that we can get into the patterns. But if you're confused, let me know in the chat. Yeah, but normally we go into that in depth each of these Fibonacci techniques in our Fibonacci series. So you can stay tuned for those, or you can go onto YouTube and take a look at those as well. Okay, so next we're talking about Fibonacci extensions. So as I mentioned earlier, Fibonacci extensions, we're looking for Nike ticks. Okay, so our starting point is the head, starting and ending point is the head of the tick. And then once price, we're looking at this V shape. Okay, so we're looking for V shape, and the tail of the tick should exceed 100% of the head. Basically, it should be longer than the head. That's what makes a tick, right? So the projected level is either the 127 or 161.8. In this case, price has already broken out of the 127, so we are expecting price to hit towards our projected level of 161.8. And you can see that's exactly what happened here, and a reversal occurred, reversed off of this level and headed back downwards. So it's another indication of a reversal. Once again, you use this in combination with your chart patterns, like the top 3 chart patterns I went through previously, your indicators, and you're good to go. Okay, here is a GIF to show you guys exactly what kind of shape you should be looking for when you are making use of Fibonacci extensions. Okay, so we're looking for reactions off of the 127.2 and 161.8. Once price breaks out of the 127, then you can go ahead and assume that price is going to reverse off of the 161.8. Okay, yeah, I just let you guys watch the GIF a couple of times and then we can move on. Okay, so we're watching the reaction of the 161.8. Okay, let's move on. So next we have the Fibonacci projection. And excuse me. So we have the Fibonacci projection, and this tool on MT4 is actually the Fibonacci extension tool. Okay, so ultimately, unlike the other three methods that we've gone through so far, this method actually requires 3 points. So we need the starting, the middle, and the ending point. Okay, so for this technique, we use namely three percentages: 61.8, 78.6, and 100%. But if you're using Elliott wave, we also make use of the 161.8. Okay, for Fibonacci projection, similarly to Fibonacci expansion, we are also looking for the flash zigzag kind of shape or lightning bolt shape, as you can see from this GIF here. Okay, so our starting point here, middle point here, ending point here, we're projecting where price will react off of. And we can see price has already broken out of the 61.8, 78.6, and that's why we can assume that price will reverse off of the 100%. Okay, let's just watch the GIF. Okay, so not included here is the 61.8, 78.6, but we're watching it play off of the 100%. Okay, and you can see it reached 100% before reversing off of it. Okay, but something I wanted to mention is that you can see that the wick of the candlestick was like just nice touched our 100% level, which is why it's important that you take note of your trade management strategies as well. You want to make sure that you remember not to put your take profit exactly at your Fibonacci levels or exactly at your confluence areas when you're using indicators, so on and so forth. And that's because price might be, it's attracted to these levels, but it's also likely to reverse off of them because of the huge confluence area. So something that we recommend normally is to place your take profit before the level or before a confluence area, basically before where you expect price to hit. And then for your stop loss, you want to make sure that you place it beyond it. So in this case, we would place our take profit higher up, above our 100%, just in case price misses it by a little bit. At least we would have caught that this reversal. Okay. Okay, let's move on. So here's another example. I'm not sure why all of my titles are covered, but here's an example of the Fibonacci projections. So you can see clearly the starting, middle, and ending points here. And these follow the swing highs and the swing lows of price. So it's important for your Fibonacci trend line to follow price movement or market structure really closely. So price has also bounced off of the 100% Fibonacci level over here. So you can see this is our shape, our flash shape, and we're expecting price to go down towards our 100%. You can see it reversed off nicely. Okay, another example. We have a very obvious zigzag or lightning bolt shape over here. So you want to take note of the Fibonacci trend line following the market structure closely. And also we have the 78.6% Fibonacci extension. So because our expansion and our projection use the same shape, more often than not, you can use both together and find confluence areas. Okay, so you can see price really bounced off of our 78.6. One more example for you guys. Starting point, middle point, ending point. You can see the shape here. 100%, we're expecting price to hit it. And you can see it reversed off of it nicely. So an invalid Fibonacci retracement occurs when price makes a lower low. Okay, so if there are bars on the right that break your ending point, it becomes invalid. So I'll show you guys what I mean. So this is what we mean. Bars on the right that break out of this lowest point. So because this is no longer the lowest point, it cannot be your ending point. Okay, so we always want to remember to pick the lowest point with nothing on the right of your ending point. So just, this is a bad example to use for a Fibonacci retracement, basically, because price has already broken out of it. Okay? Yeah. So as I mentioned earlier, market structure is really important. You want to make sure that your swing highs and lows are significant levels so that they're good points to use for Fibonacci. And yeah, this is the kind of structure that you want to look for when you are looking for Fibonacci levels, or even when you are doing your analysis, your technical analysis. Okay, I'm just gonna skip through those and get right into pattern identification. Okay, so we mentioned earlier a couple of M's and W's, but we have a couple more patterns just briefly to go through with you guys. So for these lean more towards the harmonics patterns because they're more complex and a little bit more technical to understand compared to the top three patterns that we went through earlier for continuation or for reversal. So you can see instead of our simple M, we also have extended M's, short-formed M's, instead of the simple W, as we mentioned earlier, which would be our reversal patterns. We now have extended W's and short-form W's as well. So they're just slightly more complex to understand, but once you do, they can be spotted really easily as well. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D. So similar to what we talked about earlier, we have points 1, 2, 3, 4, 5, and 6. Here we have X, A, B, C, and D. So price swings between these points are interrelated and have harmonic ratios based on Fibonacci, which is why we went through Fibonacci really quickly earlier on. So this is because Fibonacci ratios help traders in defining precise turning points in these patterns. So it tells you exactly where you can expect these swing highs or swing lows or the neckline points that we mentioned earlier that can be used as your entry and exit points. Okay. So we went through a couple of M and Ws earlier, so I'm just gonna move on to show you guys how to identify some patterns. So here are some variations of our M and W points. The breakout points, as we mentioned earlier, happen once price has broken out of the neckline area. So even though it's slightly different, uses a little bit more Fibonacci tools, but ultimately the theory behind it is about the same, or how you use it is about the same. So breakout or upside confirmation basically occurs when price breaks out of this neckline area. If we're talking about a M top, breakout or downward confirmation happens when price breaks out of this neckline. So pretty similar to what we talked about earlier. Okay, So let's talk a little bit about harmonic patterns. So all 5-point harmonic patterns have similar principles and structures, and they differ only by the ratios that are used to identify them and locate their key nodes. So in this case, we have X, A, B, C, and D, as I mentioned earlier. So I've included the Fibonacci levels as well, just for your reference. So from point A to C, it uses 38.2 to 88.6. X and B 61.8, X and D 78.6, and B to D uses more than 100% levels. But that's just for your reference. 5-point harmonic patterns have a critical origin at X, followed by an impulse wave, which is XA. So just the blue line here. So these are followed by a corrective pattern wave to form the EYE of the pattern. So this is at B, okay, completing the AB leg. Then followed by a trend wave at BC, which is another blue line here. Then ignore this line, and finally completed at the corrective leg, CD, and we call this the potential reversal zone. Okay, we call it that because we're expecting price to break out of this neckline area in order to give us downside confirmation. So it's, even though it looks a little bit more complicated, it's basically about the same as we talked about earlier. Okay, here is how we use Fibonacci in this case. Possible pattern formation is identified after the first 3 legs. So XA, AB, and BC. Then we see where exactly we can place our entry level. Normally, your entry level would come after this neckline area here, because that's where you get downside confirmation. Okay, the Fibonacci ratio extensions, retracements, and projections are then used to determine the potential reversal zones. All harmonic patterns have a clearly predefined potential reversal zone, and the initiation of new trades should take place in this zone, so over here, and only after price reversal action. So after price breaks out of this B, this B level here. Okay, so a couple of patterns for you to take note of. We have the Gartley pattern. So this is the best known harmonic pattern. So after the wave, impulse wave at XA, the corrective wave, or the corrective leg, sorry, should end at 61.8. Okay, 61.8 retracement of XA. Point C falls anywhere between the 38.2 or 88.6 retracement of the corrective leg of AB, including all harmonic trading ratios that fall between these two constraints. So it can be 50, 61.8, 70.7, 70.6, basically any level, Fibonacci level that's between these two numbers. Okay? And yeah. Long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So if we're looking at bullish, your potential reversal zone would happen obviously after this neckline level here. So your potential reversal zone would happen somewhere here. If we're looking at a sell, it would happen after it breaks past the B level. So anywhere after that. Okay. Next, let's take a look at bat pattern. So this is considered the most accurate pattern. And you can see, once again, it's pretty similar to your W and M patterns. Okay, just with a couple more Fibonacci levels to take note of. So some main rules of the pattern: AB leg can retrace between 38.2 to 50% of the XA leg. The BC leg can retrace between 38.2 to 88.6% of the AB leg. And the CD leg can retrace up to 88%, 88.6% of the XA leg. CD leg, so the last leg, can also be an extension of between 161.8 to 261.8 of the AB leg. Okay, it doesn't make sense now that you are just looking at the shape. It just looks like a bunch of numbers. But when you actually try using Fibonacci levels to distinguish the different patterns, it would make more sense then. Okay, and then for the bullish, of course, it's just the opposite of your bearish. So here's an example of a cipher pattern. So cipher pattern uses 38.2% to 61.8 for XB, 127.2 to 141.4. This is for your AC, and for XD, 78.6. And bearish is the opposite of that. Okay, so here is what a cipher pattern looks like on the chart. So you can see it's a little bit more difficult to identify because you would need to take note of the numbers, but ultimately it's still the theory behind it is still the same. Because after it breaks out of this cipher pattern, then we are expecting it to move upwards after it breaks out of this B shape here, or rather this neckline. Once it breaks out of it, that's our potential reversal zone, right? Then it's going upwards, and we can place our take profit, as we mentioned earlier, 2 times the size of your B. So from here to here, this is your potential reversal zone. So times 2 of that will be here. Okay, remember we want to place our take profit before any important levels. So we probably place it somewhere lower just to be safe, just to make sure that we catch that before the reversal occurs. Okay, butterfly patterns. So butterfly pattern requires a retracement of the impulse leg XA by 78.6. Okay, you can take a look here. So I'm just going through the different types of patterns, but there are a lot of different types of patterns. You could probably Google it. But yeah, I'm just going through the different kinds of chart patterns that you can see. Okay, but I think the most important ones are the ones that I talked about at the start. These are just more for your knowledge. Okay, so point C retraces anywhere between 38.2 to 88.6, as you can see here, of the corrective leg AB. Okay, bullish would just be the opposite of that. Crab patterns. So the crab pattern was discussed and released in 2001. So this is an extreme pattern, and the corrective wave AB should end between 38.2 and 61.8, retracement for the impulse leg of XA. Okay, long positions should be considered after a clear bullish reversal with a stop loss placed below the potential reversal zone. So stop loss would probably be somewhere here. Okay, remember the potential reversal zone is basically the area after the neckline area. Okay, bullish sharp pattern. After the impulse wave XA, the corrective leg should end between 38.2 and 61.8% retracement of the impulse leg XA here. Okay. So you can see the arrows. Once price breaks out of this level here, then we're expecting it to reverse. Similarly over here, we're expecting it to reverse. Okay, just some advantages and disadvantages for you to take note of. So they are repeatable, reliable, and do produce high probable setups. And they provide future price projections and stop loss levels as well. And they can be considered as leading indicators. Their trading rules are relatively standardized since we're using Fibonacci ratios. So, and they work on all time frames as well. Okay, some disadvantages are that they are quite complex and technical to understand and master. But like I mentioned earlier, as long as you have the basics or you kind of know what you're looking for, once you master the art of Fibonacci, then you've kind of got it under your belt. Okay. And yeah, that's all I have for you guys today. Thank you guys so much for joining me. I hope you guys found it helpful. And yeah, I will see you guys next week. Thank you guys so much for coming. Have a great rest of your week. Bye, everyone. Thanks, guys. Bye.